Hello. Hello.
Yes, sir.
Okay. If you are hearing a noise, I can't help it. It will be there. So what I'm going to do is to start a new brief section. You can see on screen sharing there is a financial statement of company as per Schedule 6. It is a vertical format. A balance sheet is being depicted. If you have having difficulty in reading it, you have that link in your WhatsApp group. You can open the same. What I'm going to discuss for another 15 minutes is why we are adopting Schedule 6 revised financial statement in a vertical format. Obviously, the answer uh, is very simple that standard format that is being followed by each and every corporation within the on the compliance level will help uh, in or increase the enhance the comparability as well as you can say the analysis of the balance sheet in a proper manner. So first thing is, what is financial statement? The final product of the accounting cycle that starts from vouching or voucher making, that ends with the preparation of financial statement like trading profit and loss, a balance sheet, as well as other statement like cash flow statement, fund flow statements, and the analysis part that is common in comparative statement as well as ratio analysis, and there are many more. What is financial statement? It is the end product or final product which we get when we are done with our complete business activity, or you can say a full accounting cycle has been completed. Financial statement of companies are depicting the information about company's income statement, commonly known as profit and loss statement. And second one is that depicts the company's financial position, commonly known as the balance sheet. Uh, Here, according to Section 211, Companies Act 1956, the balance sheet is prepared in a prescribed format, and that prescribed format headings are given. If the picture is not clear, you can go through the link in your WhatsApp group. One is the horizontal form of balance sheet. We have already covered the same till date while preparing the financial statements and their adjustments. The second is the vertical form of balance sheet. Horizontal form of balance sheet is actually termed as a T form, a capital T letter, that is T for Tatanagar, and the assets and liabilities are written side by side. On one side, the assets are written; on the other side, the liabilities are written. But in case of a revised schedule, it is written in vertical format, and you can uh, check the headings. There are two or three major headings. One is equity and liability, under which the shareholder funds, reserves and surplus, and other details are there. And the second is the non-current liabilities. That means the fixed assets will be mentioned over here. Uh, Let me share my only, okay, I cannot share two screen at a time, so I cannot write or annotate on this, but you can clearly see that under the heading equity and liabilities, there are one heading that is shareholder fund. I'm going to explain these headings in few minutes. The second is non-current liabilities. Current liabilities are there. Under the part second, the assets are listed, and under the assets, you have fixed assets. The second one is related with the investments. Current assets are there. So all these things are clubbed so that we can have a better grip on the information, and the information can be presented in proper manner. Okay. So what I'm going to do is to explain these heading one by one, and if there is any doubt, if there are newer term, you can uh, make yourself acquainted with those new terms. First is equity and liability. The equity part is related with the owner's investment, and the liability is maybe the external liabilities that like mortgages and loans borrowed from public as well as from financial institutions and bank. The first item is shareholder fund, that is share capital. I have just explained in previous video that the amount that is being generated or collected as a subscription money from the shareholder is share capital. So if any fund is collected from the shareholder, if suppose there is a share of face value 10, but the company is so confident that company is issuing that particular share for say rupees 12, then that 2 extra rupees will be termed as security premium, or you can say the capital profit when company is issuing share to the public. If suppose company is issuing share of rupees 10 for rupees 10, then that particular issue will be termed as issue at par. The newly established company or the share for the very first time cannot be issued at discount. But suppose company failed to get subscription of 90%, company is trying it again. If suppose the company share were issued say 1 year back, now the company is trying to reissue those shares, then company can offer those shares at 10% discount. All these sections are mentioned, and you cannot, section 78, section 79, all these are related with issue of shares at security premium. When you issue share beyond the nominal value, suppose 12 rupees, then 2 rupees will be the security premium. But if the company issues share for say at a discount, then that particular discount will be the capital loss for the company, and a company cannot issue share at more than 10% discount. When a newly established company or company issues shares for the very first time, it cannot issue share, that particular share at a discount from the very beginning. Only a already issued share or a share issued say 1 year back, or company working for say for more than 1 year can issue their shares at discount, because maybe the reason the situations were not favorable, the economic conditions were not favorable, the stock markets were not favorable, the corona kind of situation was there, so company failed to get any subscription in the month of March 2020. So now they are trying it again. uh, Under the non-current liability, you can have say the long-term loans or long-term borrowings from the institutions. Say you can easily see under non-current category, there are uh, long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions can be clubbed under this heading. Under current asset, what we are going to have, under current assets we are going to have like trade payables, that is bill payables, short term borrowing, bank overdraft, outstanding expenses, other current liabilities, short term provisions. You can go through the image on page 188 on the link provided under the heading financial statements of company as per schedule 6. Page 188 depicts the complete format of Schedule 6 balance sheet. What is important is that you can easily see that each and every name of the liability, current liability or fixed liability, is not required. They are clubbed, and that clubbing is the main gist in which there is a simplicity in depiction, and it is a vertical format which is required in case of companies. So from now onward, try to get command on this format as well. There is a format for the financial statement as well, and we are going to do in the section common in comparative statement analysis, where we are going to analyze the balance sheet and trading PL as per the vertical format only. Then under the category 2, the assets are listed and there are subcategories as well. First is the non-current assets. Non-current obviously are the fixed assets. There are certain tangible assets like building, machines, vehicles, etc. There are intangible assets like patent, goodwill, copyright, etc. And there is a third category like capital work in progress, where semi-finished buildings, buildings which are under construction, the machines which are still not installed, all these things are there. The category B is related with non-current investments. Actually, the company is clear that they are making these investment for long-term purposes. The investment may be in other companies. Suppose Tata is investing in Snapdeal or Freecharge, or maybe investing in some other companies. If Ratan Tata is investing his money in personal capacity, then it will not be here. But if any Tata enterprise or Tata company is investing in other companies within the group or maybe outside the non-current investment, and it will be depicted here. Deferred tax asset. See, there is a term deferred tax liability and deferred tax asset. Suppose if you have paid your taxes well in advance, which is obviously required in case of company, because companies earn such a substantial amount that tax will be there. So if a company is or has already paid enough taxes and it is over and above the requirement, then the refund is due. Then it will be a deferred tax asset for the company. If their taxes are due from the past, then it will be the deferred tax liability. So these two terms, deferred tax liability under the non-current liability and deferred tax asset under the heading non-current assets, are the new terms that you are coming across. Long-term loan and advances. If company has given loan and advances, and that is for over 1 year period to other companies within the group, that is intra-company loan, or to outside the group companies, that is inter-company loans, or maybe to other companies outside the businesses, then it will be long-term loans and advances, and will come under the head non-current asset. There are other non-current assets which may or may not be categorized under these previous three head. So it will come under the head other non-current assets. So a clubbing is done so that there may not be hundred or thousands of items mentioned separately. If there are fixed assets, they are mentioned as a gross block of assets. So all those assets which are similar in nature, like machines having same rate of depreciation, they will be clubbed as gross block of asset A. There are several other machines which may be clubbed having same rate of depreciation, say different 20%. They may be clubbed as gross block of asset B category. So it will be like that, and all the details will be mentioned under the head note of account. They were termed as schedule previously, but now the note of account will be the sections after the balance sheet, and all these note of account will mention the details what these gross of block of assets will consist of. Finally, the heading current assets will be there. Current investments, which are for short period durations, inventories, that means stocks and store items, trade receivables, that means bill receivable, cash and cash equivalent. Cash, you must be aware of. Bank balances you must be aware of. But cash, what are cash equivalent? Say suppose you are holding shares which can be easily sold by a click of a button on your computer screen. So any investments which can be sold easily termed as cash equivalent. So any investment which are not long term, which are very short term, they can be easily sold without any change in their substantial value. It's like securities held for daily trading, then foreign exchange held. Company may be having businesses abroad. They may purchase foreign exchange on a daily basis, so that if there is any fall, they these things are termed as cash and cash equivalent. There may be other short-term loan and advances may be given to or taken from the group companies. So if you have taken loan, they are short-term liabilities, and short-term loan and advances, that is short-term borrowing, will come under current liability. But if you are giving loan to the other companies within the group or outside the group for short duration, maybe less than 1 year, 4 or 5, 6 months, then it will be short-term loan and advances given or other current assets. So I've tried to explain each and every I to do. These all these sections are either 2 or 6 pages long. They are a brief introduction about all these sections, so you can go through these pages, and you can if you have any problem in any category of item, or in any specific item, you can ask me separately or within the group. I'm actually screening these pages, and I'm not getting any uh, unique item that I want to explain right now. Reserves and premium again. If suppose company is issuing share for the very first time, or maybe companies are robust company having a substantial growth in the past year. If suppose Tata or Reliance is issuing their shares, and they have actually judge that the company shares is going to be received well by the public. So what they are trying to do is to issue the face value of share, say rupees 10, at a price of say rupees 300. So this 290 rupees will be the capital profit for the company, and this will be termed as security premium. As per the sections prescribed in the Companies Act 1956, the company's management cannot use this security premium in any manner the company management likes. Uh, there are categories in which this security premium can be used. I can give you one example. If suppose there is a capital loss, then this capital profit can be used to meet out that particular capital loss. The security premium can be used to repay those shareholders which we are going to repay at a premium. If we are refunding money to, we are buying back our shares for maybe in order to avoid possible takeover or possible threat from some foreign companies, we can use this security premium capital profit for these activities. So there are certain guidelines in which this security premium money can be used. There is one thing which you want clarification on, like call in advance, call in arrear. If suppose company has issued share of rupees 10, only 8 rupees is being called up. So if you are going to pay full 8 rupees to the companies, then it will become the paid up company capital for the company, because company has issued 8 asked for rupees 8 from the public, and company has paid 8 rupees per share. So this particular 8 rupees will be the called up capital and paid up capital. But if suppose one shareholder has paid more than 8 rupees to the company, then it will be called in advance or liability on the company. If has received less than 8 rupees from suppose shareholder X, then that particular suppose shareholder X has paid only rupees 5, then this 3 rupees will be call in arrear for the company. If there is a call in arrear, it will be an asset for the company. Company may charge interest from that particular shareholder. Company is going to pay interest to that particular shareholder who has paid call in advance. But or the memorandum of association, if they are not authorized to take up call in advance as per the memorandum, then company is going to refund that money, and company is going to tell that particular shareholder that okay, you have paid 2 rupees advance, but we are not authorized to receive that money, so we are going to send that particular money back to your account. And in this manner the company can collect money from the public for initiation of their business. Okay, what I'm going to do is again log out for the next session, and the next session will be a very brief session about the financial statement analysis. It is related with management accounting. I'm going to record it again. And if that particular recording goes well, after going through that particular recording, I'll upload those recording and will provide you the link. Many of you were not able to, they have actually told me that we are not going to be present for this particular class. So I've adopted this mechanism. I'm going to log out again. This session ends, but we are going to do certain numericals for the vertical format of balance sheet in coming days. And next topic will be related with, that will be the final topic. It will be a 10 to 15-minute session for financial statement analysis. I've already provided you with all the are sounding so much in a hurry, because you all are not going to give me enough time. Actually, you are all bound enough to not to give me substantial classes to cover all these things in a proper manner. So what I'm going to do is to record all these things, or is to cover these things in such a hurry, and so that I can left with ample time in the next weeks, so that we can go through these crucial points maybe once more. So I'm going to log out now and going to log in few minutes from now.